Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I am going to describe about stock market taxation in India, key tax rules, loss set-off and carry forward provisions. Introduction. Stock market investments and trading activities are taxed differently depending on the nature of the tax of the transaction. Equity trading, futures and options, F&O, capital gains from shares and mutual fund investments fall under different heads of income and are subject to separate tax treatments. Understanding the applicable tax rates, loss adjustment provisions, and carry forward rules is essential for proper tax planning and compliance. The following information has been extracted from a publicly available website for educational and informational purposes. First, intraday equity trading. Head of income. Income from intraday equity trading is generally treated as speculative business income. Tax treatment. Profits are taxed according to the individual's applicable income tax slab rates. Loss setup. Speculative business losses can be adjusted only against speculative business profits. Carry forward. Unabsorbed speculative losses can be carried forward for up to four assessment years. Important point. Since delivery of shares is not taken in intraday trading, such transactions are classified as speculative in nature. Second, futures and options, F&O trading. Head of income. F&O transactions are generally treated as non-speculative business income. Tax treatment. Profits are taxable according to the applicable income tax slab rates. Loss setup. Non-speculative business losses can generally be set off against most income heads except salary income. Carry forward. Such losses may be carried forward for up to 8 assessment years. Important point, F&O losses are considered business losses and not capital losses. Third, equity short-term capital gains, STCG. Applicability: gains arising from the sale of listed equity shares held for the short term fall under short-term capital gains. Head of income taxed under the capital gains head. Tax rate taxable at 20% under the applicable tax provisions. Loss set-off, short-term capital loss (STCL) can be adjusted against short-term capital gains (STCG) or long-term capital gains (LTCG). Carry forward, unadjusted losses may be carried forward for eight assessment years. Fourth, equity long-term capital gains (LTCG). Applicability: gains from the sale of listed equity shares qualifying as long-term assets. Head of income taxed under capital gains head. Tax rate taxable at 12.5% after the prescribed exemption threshold of rupees 1.25 lakh. Loss set-off. Long-term capital loss (LTCL) can be adjusted only against long-term capital gains. Carry forward. Remaining losses may be carried forward for 8 assessment years. Important point. Long-term capital losses cannot be adjusted against short-term capital gains. Fifth, other assets, short-term capital gains. Head of income taxed under the capital gains head. Tax treatment: gains are generally taxable according to applicable slab rates. Loss set-off. Short-term capital losses can be adjusted against both STCG and LTCG. Carry forward. Losses can generally be carried forward to up to 8 assessment years. 6. Special rule for debt mutual funds. Capital gain classification. Certain debt mutual fund investments covered under specific provisions are treated as short-term capital gains (STCG) irrespective of the holding period. Tax treatment. Gains are taxable at normal applicable income tax slab rates. Key features: no long-term capital gain benefit, no concessional tax rate of 12.5%, no indexation benefits. 6. Special rule for debt mutual funds. Loss set-off: short-term capital losses can be adjusted against STCG, LTCG. Carry forward. Losses may generally be carried forward for 8 assessment years. Important observation: for specific debt mutual fund units covered under by the relevant provisions, the holding period may become relevant for determining the tax rate. Common mistakes taxpayers should avoid. First, treating F&O losses as capital losses. F&O income is generally considered business income and not capital gains. Second, treating intraday profit as STCG. Intraday equity is trading is generally classified as speculative business activity. Third, assuming debt mutual funds always qualify for LTCG. Certain debt mutual funds are taxed at short-term capital gains irrespective of holding period. Fourth, assuming all capital losses are interchangeable. Short-term capital losses are more flexible. Long-term capital losses have restricted adjustment provisions. Quick reference summary. So transaction type, their income head, tax treatment, and carry. First, intraday equity trading. The income head is speculative business, tax treatment, slab rates, and carry forward for 4 years. Next, F&O trading. The income head, non-speculative business, tax treatment is slab rates, and the carry forward is for 8 years. Equity STCG, capital gains, income head, tax treatment 20%, carry forward 8 years. Equity LTCG, capital gains, income head 12.5% above exemption limit is the tax treatment and carry forward for 8 years. Other assets STCG, capital gains, income head, the tax treatment is slab rates and carry forward is for 8 years. Specified debt mutual funds, income head STCG, tax treatment, slab rates and carry forward for 8 years. Conclusion: stock market taxation depends largely on the nature of transaction and the classification of income. Intraday trading, F&O trading, short-term capital gains, long-term capital gains, and debt mutual funds each have distinct tax treatments, loss adjustment rules, and carry forward provisions. Investors and traders should maintain proper records and understand the applicable provisions to ensure accurate tax reporting and effective tax planning. Disclaimer: this article is intended solely for educational and informational purposes and has been extracted and compiled from information available on a website. Tax laws, rates, exemptions, and interpretations may change from time to time based on amendments, notifications, judicial decisions, and regulatory updates. Readers are advised to refer to the latest provisions of the Income Tax Act, relevant rules, and official government notifications, or consult a qualified tax professional before making any financial or tax related decisions. This content should not be construed as legal, financial, investment, or tax advice. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.